MPW is down a massive 56% year to date, with a yield touching 12%. But are we seeing a huge opportunity after their dividend cut, or is there seemingly a obvious trap? Now, in today's episode, what we want to understand is, can we be locking in this very cheap price and see this price double, triple, or even quadruple over the next few years, along with this yield on cost, which is already starting at double digits? And can we see it over the next few years at 12, 13, 14, or even 15% with our yield on cost? We're going to look at the historical performance of the company. We're going to jump into their income statements, looking at their latest annual reports, their top line revenue growth, bottom line net income. We're going to look at their balance sheet to see how safe are those dividends, looking at total cash versus total debt. And we're going to jump into their competitors that they have in the healthcare REITs market, how they have performed over the last 5 years, which ones are better than MPW, or is we looking at the top of that industry. As always, we are going to jump into the dividend safety, understand the score, the supporting financial metrics, seeing whether or not the market has oversold it completely, and then run it through our stock valuation model, getting to our intrinsic value, our acceptable buy price given our margin of safety. Now, year to date, it has been hammered 56% down, and over the last 10 years, investors who have had an investment would have seen their investment down 59%. Now, this doesn't include those dividends reinvested, but regardless, that is a shockingly bad return on any investment over the last 10 years. And what we want to understand now is, can we take advantage of this price, which seems to be oversold, locking in some very strong share price appreciation over the next few years, as well as getting a very nice yield to hold these shares over the next short-term or long-term period. It is at the 52-week low or thereabouts, as we can see. And in terms of the company as a whole, well, how is it performing? In terms of the revenues, what do we love to see? Well, for REITs in particular, 5 to 10% growth year on year. December 2018, 800 million on the top line. December 2022, their latest annual report, around 1.6 billion. So we can in fact see double the top line over the last 5 years. Very, very positive to see. And as well as that, we can see consistent growth over the last 5 years. Again, very positive to see. And we will touch upon the last 10 years as well as percentage terms. Now, in terms of the bottom line, which is also as important, if not more, how has that performed? Well, the net income in 2018, around 1 billion on the bottom line. Very, very strong. Latest annual report, unfortunately, it is a dip from the last 5 years to 903 million, which is not great at all. If the revenue has doubled over the last 5 years, you expect their bottom line at a minimum to have increased, but we can see it's done the opposite. And when we look on a more granular level, we can see, in fact, it's decreased from 2018 to 19 before increasing, as we can see. So inconsistent in line with the top line. So a slight worry there, which we can dive deeper into. Now, I love to look at the balance sheet. We do a quick health check, total cash versus total debt. 2018, 821 million on the balance sheet. Latest quarterly report, 324 million. So in fact, they are holding less cash over the last 5 years. And in terms of how that compares numerically and directionally to their total debt, well, we can see 4 billion in total debt in 2018. Latest quarterly report, 10.3 billion or 10.2. So they've, well, essentially doubled their total debt, nearly tripled in fact, whereas they've reduced their cash balance. So a slight worry, but again, we will touch upon this when looking at our financial metrics. Now, very quickly, before jumping into the dividend safety as well as the supporting metrics, what we're doing here is looking at companies in the same industry, in the healthcare REITs, as we can see. With the market cap of MPW at 3 billion, we can see roughly in line with that. LTC, the smallest one, the smallest comparative at 1.3 billion, and how they compare. So over the last 5 years, what do we essentially see? We can start, in fact, with the year-to-date performance and work our way from there. So year-to-date, MPW has essentially been the worst performing, down 52%. We can see SBRA, in fact, 19%, very positive to see in comparison to MPW, and in fact outperforming the S&P 500. And then we can see the same for CTRE. So in fact, year to date, MPW has been the worst performing. Over the last 5 years, however, what is that story that we can see with these essential comparative companies? So what we can see, and we are looking here essentially at the total return, which includes those dividends reinvested. Over the last 5 years, MPW down 50%, SBRA down 5%, DOC down 6.5%. And in fact, all of them bar CTRE, which is up 56%, have in fact or would have lost money on your total investment. So something just to bear in mind over the last 5 years. But again, we're not necessarily looking at previous historical data to pave the pathway for the future, but it is always good to understand how the industry as a whole has performed. Now, their dividend safety score, 20 straight away, red flag, very unsafe. This is after, as we can see here, the 48% cut in their revenue in August, so only a few months ago. Market cap 3 billion, making it a mid-cap company. So let's take a look and do a deeper dive. So key metrics for those that believe a recession is looming. Well, last recession, in fact, they cut the dividend 0709. Recession sales, negative 5%, though interestingly, this was above the average growth rate of companies in the S&P 500, which was negative to a greater degree. And as we can see, the recession return, negative 76%, far underperforming the S&P 500's negative 55. So just a few things to digest for investors that believe a recession is looming. Now, obviously, given the dividend cut they had in August, negative 48%, their dividend growth starts from zero. Last 5 years, 4%. Last 10 years, 4%. Now, one thing just to bear in mind for those that are new to the channel, the reason why I always say 4% as a minimum is what you want in your dividends is due to the fact the US inflation rate was 4% over the last 40 years. Anything less, you are taking a pay cut and losing your purchasing power, whether it's your dividends, salary, or other income producing assets. So do bear that in mind. However, if you were to essentially lock in that yield that we see right now at just under 12%, and you are essentially getting a 4% increase year on year, you are locking in a very high yield, which is essentially keeping up with inflation year on year, if that was to happen. Now, dividend yield theory states that the company is undervalued when the current yield sits above the 5-year average. So 11.76 versus 5.68, we have our first sign of undervaluation. But as always, we never look at any model in isolation and we'll draw our conclusions towards the end of the episode. Forward P to AFO, again, another sign, 4.5 versus 14.5. And we can see the sector P to AFFO comparison, 4.5 for MPW with the real estate at 12.4. Now, looking at the 52-week price range, what do we see? Well, essentially, it is sitting at the 52-week low, but bear in mind, it's very important to understand 52-week low does not signal undervaluation. Likewise, 52-week high would not signal overvaluation. Now, those that are new to the channel need to understand that typically for companies, we have the earnings payout versus the free cash flow. And I would tell the viewers essentially, ignore earnings data. It is susceptible to manipulation by management through accounting and focus on free cash flow as it is the preferred metric. However, we tend to ignore the free cash flow payout for REITs as it is more volatile and you do have items such as upfront rent payments, maintenance expenses and deferred financing costs skewing the data. So for REITs, we tend to focus on adjusted funds from operations. Below 95% is what we look for medical building REITs. What we can see, in fact, for the large part, it has been but it has been below that. The last few years, 82%. 2023, given the dividend cut, it is around 53%. So again, positive to see it is starting to come down. But again, it's just something to bear in mind. If we do see it to go up over 100%, that would be a worry. But so far, so good. Again, focusing on the adjusted funds from operations per share, 93 cents in 2013, 142 in 2022. It is going up in the right direction, but bear in mind the inconsistencies that we see here. It's not always increasing year on year. And 2022 at 142, 2023 is expected to be 114. Now, as I mentioned, sales growth, what do we look for REITs? 5 to 10%. For the majority of the years, essentially medical properties has been smashing that year on year. Do bear in mind 2022 it only increased by 1%, and looking at it numerically, 250 million sales in 2013, 1.58 billion in 2022. So it has been increasing revenue very nicely year on year, but again do bear in mind that essentially that flat period over the last year or two. Shares outstanding, one thing I talk about a lot. We love it as investors when companies do share buybacks, returning excess cash to our pockets. What we don't love, unfortunately, is the opposite, where they essentially are diluting our position in the company. However, this is very, very common with the REITs. They do the opposite, where they issue shares due to the fact that they want to fund property acquisitions, and given the fact they don't essentially keep their generated internal cash flow as they pay it out as dividends, as we saw very high dividend payout ratios, they're forced to do these shares outstanding. So do bear that in mind. Then we move on to ROIC, one of my 7 golden dividend metrics. If you want to see the other 6, do check the pinned YouTube video. What we tend to look for, 3 to 5% year on year for REITs. Normally for other companies, it'd be 10% plus. The reason for those figures, as it's what I like and it gives me faith management are able to effectively allocate their capital. So I'm personally happy with what I see, between 3 to 5%, in fact, higher than that in some years, as we can see 2022 at 6%. Now, operating margin, what do we look for? Well, the higher the operating margin, the more essentially we can see the advantages of the business, the higher the moat, and it means the higher the margin, the higher the bottom line net income will be, which will then transcend into more dividends to the investors and a higher dividend safety score. So very positive to see consistently above 60%, in fact, year on year, and in the high 60s. So that is very, very positive. And then the main thing that I would say is a worry, which is why we can see this dividend safety score low, as well as the previous dividend cut, is the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. What we look for is 6 and below, 6 signaling the number of years it would take the company to pay off all their debt, net of cash on hand. In fact, nearly every single year it's been above that, bar 2018. Now 2022 is at 7.54. Bear in mind, 2023 is expected to be the highest it's ever been at 8.54. This is ultimately going to put pressure on that high dividend, as we can see by this dividend safety score. So my personal concerns are that essentially we are seeing the total debt getting out of hand, climbing higher and higher, essentially in a position where they may be taking out debt to pay their dividends. So we could potentially see another dividend cut. So do bear that in mind, understand the information when you are thinking about investing, or if you are a current investor. Now, as always, if you are enjoying the video, value is being provided, please smash that like button. It really helps the channel. And if you want to subscribe, if you haven't already, and hit that bell button to join this lovely community, have these videos delivered to your doorstep very, very frequently, then do hit that button. And as always, if you want to grab a copy of the valuation model to run your own companies through to get your own intrinsic value, whether it's for MPW or other companies that are similar, do click on the pinned comment below. So typically our first valuation model is Graham's valuation formula. However, for REITs, it's not appropriate, so we do not use it. But for those that are new, I'll quickly run through. We input the stock ticker, the earnings per share, growth rate per analyst estimates, and that current yield on AAA corporate bonds. We then get the intrinsic value, which in this case is 331 based on Graham's valuation. Again, not applicable for REITs, but it's how we essentially use it for the other companies. So we then move on to the multiples valuation model, companies that we literally just saw when we were analysing the 5-year performance as well as the year to date. Omega Healthcare, Healthcare Realty, Physicians Realty, and Sabre Healthcare REIT. We have their stock price, P to AFFO multiple. We get the average divided by that of MPW, multiply that by the current price to get MPW's multiples valuation price of 1477. Now, as we can see, that is significantly higher than the trading price and essentially right there at the current 52-week high, showing signs of essential 3 times the current trading price. So strong signs of undervaluation. But as always, bear in mind, we never look at any model in isolation and we'll draw our conclusions towards the end of the episode. Now we move on to the dividend discount model. And unfortunately for investors, we see that dividend cut. So the average growth rate is skewed to negative 7% for this. Moving forwards, now I have gone with an extremely low growth rate. And again, for those that believe you can justify a higher percentage, or if you think for a flat 0%, then again, grab the copy of the model. You can use your own estimates and judgments to get to your own prices. However, based on my estimate and judgment, is giving a DDM price of just under $8. Again, showing some nice upside to the current trading price, above 50%. And don't forget, you are locking in that very high yield. We then move on to the third and final model. We have the discounted cash flow model with the free cash flows year on year. Some very strong growth rate over the period. And as we can see, that 1% per analyst estimates alongside that discount rate of 8%. We then essentially get the present value of the free cash flows and terminal value. Add that together with the cash, subtract total debt and arrive at the equity value. Divide that by the shares outstanding to give a DCF price of around $7.34. Again, upside to the current trading price and within that 52-week range, showing signs of undervaluation. As always, if you are enjoying the content, do smash that like button. It really helps the channel. And do essentially subscribe if you want to join this lovely community. So the intrinsic value is essentially the average of the three models that we have just run through, coming just shy of $10. Now, in terms of the current price, it is sitting around $5.10. And for those looking for a margin of safety, which I would highly recommend, 10% is what I would say if you believe the company has a wide moat, strong financial metrics, and good forward-looking data. Now, personally, for MPW, I would not say 10%. I would go much higher. So for those looking at 25%, your acceptable buy would be up to $7.47. Those looking at 35%, up to $6.47. Those looking at 40%, again, this does really come down to essential investor safety and margin of safety, up to $5.97. Those looking for a margin of safety of 45%, up to $5.48. And those looking for a margin of safety of 50%, your acceptable buy would be just shy of $5. Now, do let me know your thoughts in the comments below. Are you looking to add MPW? Are you looking to sell? Or are you purely on the sidelines speculating? Now, Wall Street are forecasting their price to have upside as well, up to $8.50 over the next 12 months. As we can see, slightly lower than the intrinsic value, but this is their target price over the next 12 months. As always, do hit the like button if you have enjoyed the video. Value has been provided. It really helps the channel. Do subscribe if you haven't already to join this lovely community where we have essential daily stock videos reviewed. And as always, if you do want to grab your valuation model to run your own companies through to get your own intrinsic value of companies and acceptable buy price, whether it's MPW or other companies, do click on the pinned comment below. As always, have a great day. Catch you on the next episode and take care.